Imagine waking up to a notification on your smartphone that feels like a glitch, but is actually a systemic realignment. You open your banking app to pay for a routine morning coffee, only to see a red banner across the top. Account restricted, regulatory compliance. You try to transfer funds to another account, but the button is grayed out. This is not a hack, and your bank has not gone bankrupt. Instead, the infrastructure of the global financial system has simply decided that your liquidity is no longer your property. It is a quiet, bloodless coup executed through a few lines of code. For decades, we have lived under the illusion that money in a digital ledger is a static representation of labor and time. In reality, it is a conditional permission slip issued by a state that is currently drowning in its own mathematical contradictions. As national debt spirals toward $40 trillion and interest payments eclipse the military budget, the state is running out of traditional options. It cannot tax its way out of this hole, and it cannot grow its way out. The only remaining move is to trap the capital within the system and devalue it at will. This investigative journey is not about a temporary market crash or a partisan political shift. It is about the structural inevitability of a second Nixon shock, a fundamental breaking of the contract between the citizen and the state's currency. If you want to understand how the architecture of your savings is being redesigned into a programmable cage, you need to stay until the very end of this analysis, where we will reveal the specific mechanism that will be used to lock the exit ramps. Before we dive into the numbers that the mainstream financial press refuses to aggregate, I invite you to subscribe to Beneath the Numbers and hit the notification bell. We don't just report on the news. We engineer the blueprints of why these systems behave the way they do. By joining this channel, you are choosing to look beneath the surface of the global economy. Now, let us examine the geometry of the coming collapse. The current financial architecture of the United States is no longer a functioning market. It is a mathematical trap. When the national debt surpassed $35 trillion, it crossed a threshold where the cost of servicing that debt began to cannibalize the government's ability to function. With interest rates held higher to combat persistent inflation, the annual interest expense alone has breached the $1 trillion mark. This creates a feedback loop where the government must borrow more money just to pay the interest on what it has already borrowed. In physics, this is known as a runaway reaction. In economics, it is the precursor to financial repression. The state requires a way to force the public to hold its debt at interest rates that are lower than the rate of inflation. To achieve this, the state must eliminate the competition. It must ensure that you cannot flee to gold, to foreign currencies, or to decentralized assets without significant friction. This is the structural necessity of capital controls. The debt is too large to be paid, too large to be defaulted upon, and too large to be ignored. Therefore, it must be managed through the containment of private wealth. To understand the future of frozen accounts, we must look back to August 15, 1971, the date of the original Nixon shock. At that time, the world operated under the Bretton Woods system, where the US dollar was pegged to gold at $35 per ounce. Foreign central banks could, in theory, exchange their excess dollars for physical gold from the U.S. Treasury. However, the cost of the Vietnam War and the expansion of social programs under the Great Society had forced the United States to print far more dollars than it had gold to back them. When nations like France and Great Britain began to realize the bluff and demanded their gold, the U.S. faced a systemic liquidity crisis. Richard Nixon did not apologize. He acted with the cold efficiency of a state in survival mode. He went on national television and unilaterally suspended the convertibility of the dollar into gold. This was a temporary measure that became permanent, effectively ending the gold standard and ushering in the era of pure fiat currency. The 1971 shock was a masterclass in narrative framing. Nixon blamed international money speculators for the instability, much like modern leaders blame market volatility or national security for banking restrictions. By closing the gold window, the United States effectively defaulted on its international obligations while retaining its status as the world's reserve currency. This allowed for an unprecedented expansion of credit and debt over the following 5 decades. However, that expansion has now reached its terminal phase. The original Nixon Shock freed the state from the constraint of physical gold. The second Nixon Shock will free the state from the constraint of private liquidity. In 1971, the state locked the door to the gold vault. In the coming years, the state will lock the door to the digital bank account. The mechanism is the same: the unilateral suspension of a promise to ensure the survival of the sovereign entity. The infrastructure of the 1971 shift required nothing more than a televised announcement and a change in Treasury policy. The transition was possible because the dollar was already the global unit of account. Today, the dollar remains dominant, but its internal structural integrity is compromised. The M2 money supply, which represents the total amount of cash and checking deposits in the system, has seen historic fluctuations. When the state injects trillions into the economy, as it did in 2020, it creates a massive overhang of liquidity. When it then tries to drain that liquidity to fight inflation, it risks collapsing the banking system that holds the debt. This tension is what makes a second shock inevitable. The state cannot allow the capital to leave the system during this transition because the system itself is the collateral for the national debt. If we analyze the 1971 event as a precedent, we see a recurring pattern of state behavior. Identify an external enemy, declare an emergency, and break the existing financial contract. In 1971, the contract was dollars for gold. In 2025 and beyond, the contract is deposits for cash. The shift from a physical gold peg to a digital ledger peg is merely a change in the medium of control. The underlying logic remains the same. The state is an entity that prioritizes its own continuity above the property rights of its citizens. When the debt reaches the level of $35 trillion, property rights become a secondary concern to systemic stability. The mathematics of the current debt trap are inescapable. When the Federal Reserve raised interest rates 11 times between 2022 and 2023, it was attempting to kill the inflation that the government's own spending had created. However, these higher rates had a secondary, more dangerous effect. They made the cost to the national debt explode. For decades, the U.S. government enjoyed a period of ultra-low interest rates, allowing it to borrow trillions for nearly zero cost. Those days are over. We are now in a regime where the government must refinance trillions of dollars in short-term debt at rates that are double or triple what they were just a few years ago. This is the interest rate trap. If the Fed keeps rates high, the government goes bankrupt from interest costs. If the Fed lowers rates to save the government, inflation returns, and the currency loses its value. In this scenario, the banking system becomes the primary tool for state survival. Commercial banks are the largest holders of government debt. When interest rates rise, the value of the older, lower-interest bonds held by these banks drops significantly. This was the trigger for the collapse of Silicon Valley Bank and Signature Bank in early 2023. The banks were technically solvent, but suffered from a liquidity mismatch. They held long-term government debt that no one wanted to buy at face value. To prevent a systemic contagion, the Federal Reserve had to step in with emergency lending facilities. This was a warning shot. It demonstrated that the private banking system is now inextricably linked to the government's debt pile. The banks cannot fail because the government needs them to buy its bonds, and the government cannot let the banks fail because they hold the public's deposits. This interdependence leads directly to the account frozen scenario. If a major wave of bank runs were to occur today, the system would not have the physical cash or the liquid assets to satisfy the demand. There is a massive gap between the $17 trillion in total bank deposits and the actual physical cash and liquid reserves held by those institutions. To prevent a total collapse during a period of high debt stress, the government would have no choice but to implement a bank holiday or a withdrawal limit. This is not a conspiracy theory. It is a standard operational procedure found in the living wills of major systemic banks. They have the legal authority to suspend withdrawals if the stability of the institution is at risk. The trap is further tightened by the decline in foreign demand for U.S. treasuries. For years, countries like China and Japan were the primary buyers of American debt. Recently, these nations have become net sellers, or have at least slowed their purchases significantly. This leaves the Federal Reserve as the buyer of last resort. When the Fed buys debt, it creates new money, which is inflationary. To counter this, the state must find a way to sterilize that money, essentially trapping it so it doesn't cause a hyperinflationary spike in consumer prices. The most effective way to do this is to limit the velocity of money through digital controls. If you cannot move your money quickly, or if you are restricted in what you can buy, the inflationary pressure is artificially suppressed. The ultimate infrastructure for the Nixon Shock 2.0 is the central bank digital currency, or CBDC. Unlike the digital numbers you see in your current banking app, which are liabilities of a private commercial bank, a CBDC is a direct liability of the Federal Reserve. This represents a fundamental shift in the plumbing of the financial system. In a CBDC environment, the government does not need to ask a bank to freeze your account. It can simply update the permissions on your digital wallet at the source code level. This is the programmable wall. It allows for the implementation of capital controls that are automated, instantaneous, and granular. The state can decide that your money can only be spent on certain categories of goods, or that it cannot be moved out of the country, or that it has an expiration date to force spending and stimulate the economy. The push for CBDCs is often marketed as a way to increase financial inclusion or speed up payments. However, from a structural perspective, the primary utility of a CBDC is to solve the debt problem through financial repression. If the state needs to force interest rates below the rate of inflation, it must prevent people from withdrawing their money as cash. In a world of physical cash, if a bank offers a negative interest rate, you can simply take your money out and put it under your mattress. In a CBDC world, there is no mattress. Your money is trapped in the digital ledger, and the state can apply a negative interest rate, essentially a wealth tax, with a single keystroke. This is how the $35 trillion debt will eventually be paid, by slowly draining the purchasing power of the trapped digital deposits. The technological architecture of a CBDC also allows for geofencing of capital. If the government detects a flight of capital toward a specific asset class, such as gold or decentralized cryptocurrencies, it can simply block transfers to those specific exchanges or vendors. We have already seen the blueprint for this in the 2022 Canadian trucker protests, where the government invoked emergency powers to freeze the bank accounts of protesters without a court order. This was a proof of concept. It showed that the digital payment rail is a political tool. In a Nixon Shock 2.0 scenario, this tool will be used not against a specific political group, but against the entire population to prevent a systemic exit. Furthermore, the implementation of a CBDC allows for the total transparency of every transaction. This level of data gives the state the ability to predict and preempt market movements. If the data shows a spike in citizens trying to convert their digital dollars into harder assets, the system can automatically trigger circuit breakers. These are the same mechanisms used on the stock exchange to stop trading during a crash. In the future, the circuit breaker will be applied to your personal liquidity. When the system detects a loss of confidence, it will simply freeze the accounts until stability is restored. This is the inevitable evolution of a debt-based system that has run out of room to expand. The transition to a controlled digital system requires the systematic elimination of exit ramps. The most significant exit ramp for the average citizen is physical cash. Cash represents anonymity and, more importantly, it represents a claim on the banking system that can be held outside of the digital infrastructure. This is why we are seeing a global war on cash. Governments around the world are lowering the legal limit for cash transactions and closing bank branches at an accelerating rate. The goal is to make the economy cash-light before making it cashless. Once cash is effectively removed, the state has total control over the velocity and direction of capital. Other exit ramps include precious metals and decentralized digital assets. In the original 1933 gold confiscation under Executive Order 6102, the U.S. government forced citizens to sell their gold to the Treasury at a fixed price. In a modern context, a physical confiscation is unlikely because it is logistically difficult. Instead, the state will use digital confiscation through taxation and regulation. By making it nearly impossible to move money from a bank account to a crypto exchange or a gold dealer, the state effectively closes the exit. We are already seeing Operation Choke Point 2.0, where banks are being pressured to cut off services to firms in the digital asset space. This is the structural construction of the digital cage. The death of cash is not a result of consumer preference. It is a policy objective. When you pay with a credit card or a phone, you're leaving a digital footprint and keeping your capital within a controlled network. When you pay with cash, you're operating in the black hole of the economy where the state cannot track, tax, or freeze your labor. For a government with a $35 trillion debt, these black holes are a threat to national security. Every dollar that leaves the formal banking system is a dollar that cannot be used to buy government bonds or be taxed to pay interest. Therefore, the closure of cash exit ramps is a prerequisite for the Nixon Shock 2.0. In the final stages of this transition, we will likely see a dual-tier monetary system. There will be the official digital currency, which is subject to all controls and devaluations, and a black market for hard assets. However, the state will use the narrative of combating money laundering or funding terrorism to criminalize the possession of these hard assets. This is the same rhetoric Nixon used in 1971 when he blamed speculators for the dollar's weakness. The state never admits that its own fiscal profligacy is the cause of the crisis. It always blames the citizens who are trying to protect their savings. To see how this plays out in real time, we only need to look at the periphery of the global financial system. In 2013, the nation of Cyprus faced a massive banking crisis. The solution, dictated by the troika of international lenders, was a bail-in. Unlike a bailout, where the government uses taxpayer money to save banks, a bail-in uses the depositor's own money. Anyone with more than 100,000 euros in the bank saw a portion of their savings converted into bank equity, which was essentially worthless. For weeks, ATMs were limited to 100 euros a day, and capital controls prevented money from leaving the island. Cyprus was a laboratory for the modern account-frozen scenario. It proved that in a crisis, your bank deposit is not your money. It is an unsecured loan to a failing institution. Similarly, in 2019, the financial system of Lebanon collapsed under the weight of a sovereign debt pyramid scheme. The banks simply stopped allowing people to withdraw their dollars. If you had life savings in USD, the bank would only let you withdraw them in local Lebanese pounds at a rate that was 80% lower than the market value. This is a stealth haircut. The numbers in the bank account stayed the same, but the ability to use them was destroyed. People were forced to watch their life's work evaporate while the accounts remained active but useless. This is exactly what financial repression looks like. The state maintains the illusion of a functioning system while preventing any meaningful exit. These examples are not anomalies. They're the standard response of a debt-saturated system. The only difference between Lebanon or Cyprus and the United States is the scale and the timeline. Because the US dollar is the global reserve currency, the United States has been able to export its inflation and delay its reckoning for much longer. But the underlying mechanics of debt remain the same. When the interest on the debt exceeds the growth of the economy, the state must eventually resort to the Cyprus model. It must lock the doors and take a haircut from the depositors to recapitalize the system. The account frozen notification is the digital equivalent of a line of people standing in front of a closed bank door. In the past, you could see the crisis because people were physically blocked from their money. In the future, the crisis will be invisible. You will sit at home, looking at your screen, and everything will look normal, except for the fact that you cannot move your money. The lesson from the periphery is that by the time the controls are announced, it is already too late to leave. The state always moves faster than the individual during a systemic reset. Financial repression is the process by which a government uses a combination of regulations, taxes, and inflation to transfer wealth from the private sector to the public sector. Its primary goal is to reduce the real value of the national debt. If the government owes $35 trillion and inflation is 10%, but the interest rate it pays on the debt is only 2%, the real value of that debt shrinks by 8% every year. This is a massive transfer of wealth from anyone who holds dollars or bank deposits to the government. For this to work, however, the government must prevent you from finding an investment that pays more than the rate of inflation. This is why we see the rise of ESG, environmental, social, and governance, and other non-financial mandates in the banking sector. By forcing banks to allocate capital according to government-approved criteria, the state ensures that credit is directed toward its own interests rather than the most productive parts of the economy. It also creates a system where non-compliant individuals or businesses can be debanked. If your social credit score or carbon footprint is too high, the system can simply restrict your access to credit or freeze your ability to transact. This is financial repression disguised as social progress. The invisible tax of inflation is the most effective tool in the state's arsenal. Unlike a direct tax, which requires a vote in Congress and is highly unpopular, inflation is a hidden tax that most people do not understand. They see prices going up and blame the grocery store or the oil company, rather than the central bank that increased the money supply. When combined with capital controls, inflation becomes a trap. You are forced to watch your purchasing power melt away, and you are legally or technologically prohibited from moving your money into an asset that would protect you. This is the new normal for the global economy. We are entering a period where the traditional rules of saving and investing are being rewritten. In the past, the goal was to achieve a real return on your capital. In the era of the Nixon Shock 2.0, the goal will simply be return of capital, trying to keep what you have from being absorbed into the state's debt-burning furnace. The geometry of the system requires that the public loses so that the state can survive. There is no other mathematical path. We have examined the components of the coming shift: the $35 trillion debt, the interest rate trap, the technological infrastructure of CBDCs, and the historical precedent of the 1971 Nixon Shock. When we synthesize these elements, a clear picture emerges. We are not looking at a single event like a stock market crash, but a fundamental phase transition in the nature of money itself. The global economy is moving from a system of permissionless liquidity to a system of permissioned access. In the old world, if you had $1, you could spend it. In the new world, the spending of that dollar is a request that must be approved by central authority in real time. The inevitability of this transition is driven by the sheer scale of the debt. Systems that are this over-leveraged cannot be reformed. They can only be reset or repressed. The state has chosen repression because it allows the existing power structures to remain in place while the cost is distributed across the entire population. The Nixon Shock 2.0 is the ultimate solution to the sovereign debt crisis. It allows the government to default on its obligations in real terms without ever having to announce a nominal default. The numbers in the bank account stay the same, but the world they can buy disappears. This process will likely be triggered by a managed crisis, a period of extreme market volatility, or a cyber attack on the financial system that provides the political cover for the implementation of emergency controls. Just as the 1971 shock was framed as a defense against speculators, the 2025 shock will be framed as a defense against instability or malicious actors. The result will be the same: the suspension of the previous financial order and the birth of a new, more controlled regime. The cage is being built while we are still inside it, and most people are too distracted by the noise of the market to hear the locks clicking into place. Understanding this system is the first step toward navigating it. We are moving into an era where liquidity will be the most valuable asset, and access will be the most contested right. The The state will continue to project an image of strength and stability, even as it takes increasingly desperate measures to keep the debt machine from seizing up. The numbers do not lie, and the numbers tell us that the current path is unsustainable. When the path ends, the walls go up. The account frozen notification is not a warning. It is the final step in a process that began over 50 years ago. When Richard Nixon severed the link between the dollar and gold, he initiated a countdown. We are now living in the final seconds of that clock. The $35 trillion debt is not just a number on a screen. It is a claim on your future labor and your accumulated savings. As the state prepares for its next great pivot, the most important thing you can do is recognize the pattern. Don't wait for the televised announcement or the red banner in your banking app. By the time the system admits there is a problem, the exit ramps will already be closed. If this investigation has helped you see the structural reality beneath the surface of the global economy, please share this video with those who still believe the old rules apply. Your support through likes and subscriptions allows us to continue producing these deep dive analyses into the mechanisms of power and money. Remember, we aren't explaining what might happen. We are explaining why systems always behave this way. Protect your perspective, watch the numbers, and prepare for the shock. Thank you for watching. See you in the next video.